Okay, so the learning goals for this chapter. This may have picked up or did. Okay. Technical difficulties. All right, so things that we could use to kind of value a company's future. A big part of it depends on the future returns, dividends, capital gains, losses. Um, Historical data can give us an idea of how they've been doing in the past, but the past results aren't guaranteed for future results. But they are a good starting point. If they've been a good earner and they've been good at making new products, expanding their sales, increasing their efficiencies, they'll probably do that more in the future. You just have to make sure that the elements of their success that led to their past success are still there and still in place for the future. You know, that their products are going to have a demand, that their management team is still good, and that they're on top of things. Because as the business world is constantly changing, if companies don't adapt to it, they fall behind and other companies replace them. So that's the risk. That's why it's very rare that you're going to own a stock your whole life, because many companies that you see around you today just won't be here in 20 years. And just like when if I go to the Smith Haven Mall, I was there 20 years ago. The only stores that are still there are Sears, Macy's. I think that's it. I think everything else has changed. You know, new stores come in, old stores leave. It's just a constant turnover in that mall as people's tastes change, different retail locations and brands change, and it's just a constant world of flux. So companies need to be on top of that. Now, one area that we talked about last chapter was financial statements, and the income statement is, one of the things that we can look at as far as analysis. We can take percentages of the different items in the financial statements. For example, if we look at percentage of sales, we have cost of goods sold is 58.2% of sales. Gross profits 41.8%, means every dollar of sales turns into 41.8 cents. And we could look at proportionally, where are we spending the money on selling, depreciation, other expenses. In this company, 25% of their sales go to selling costs. And this just gives us a comparative way to take an income statement and make it comparative to other companies. Because if you're just working on percentages, then you could see, and this is something that we probably should have did with the last class. I had the spreadsheet of McDonald's, Wendy's, and Yum brands, and it was hard to really interpret. We're using the financial ratios, which do kind of make a common size, but we could also use these percentages to see who's more efficient in their operations and their profitability. But if we're going to create a valuation process for a company, there's 3 steps necessary. I don't want to say it guarantees a valuation, but it sort of gives you a good estimate. So one would be forecasting future sales and profits. You can see what I'm saying is an estimate because you're forecasting. And this is the problem I laugh at sometimes when you guys play that. When I do the 3:30 class, we do the simulation, and people say, okay, so I'm going to forecast the sales, so what's that number? I say, what do you mean, what's that number? I don't know. You have to figure it out. Well, no, this program's stupid. They should tell me the forecast number. I don't see how I'm supposed to get that. And they get upset because there's really no official formula or way of getting an accurate forecast. They don't get the concept that, you don't know. Companies have to try to work as best they can to kind of figure out what to do. And how many pairs of jeans should I have in my store? How many bottles of water should I stock in my store? How many seats should we have in the classroom? And all these different things are all based on, what's the forecast of our future demand. And this is something that's not a very easy thing to do. But there are certain clues and certain connections you can make, and better analysts have better toolbox at doing this. For example, some industries you can see that if the economy grows by 3%, the company grows by double that, 6%. Or, there's relationships you could develop between, you could just look at, hey, this company's been able to increase sales 5% every quarter for the past 20 years. I think it's a reasonable estimate they're going to do that forward. And even companies will give you a hint or even forecast for you and say, this is what we expect. But if you have your future sales, you can develop your future profits based on what we're just looking at in that percentage. So if you had my 330 class, we worked on pro forma financial statements. And those are based on percentages of sales. So when you're estimating things, you tie everything to a percentage of sales like we saw in the previous slide. So everything here is, so if we have this much in sales this year, and this is how things laid out in percentages all the way down to net profits, if sales go up, are 1.9 million and now they're 2.8 million, you should be able to use these percentages to calculate a good estimate for next year's profits based on an increase in sales. So the first step is estimating next year's sales and how that translates to profits. So a lot of things you can assume are going to have the same relationship: cost of goods sold, expenses selling, to the amount that they sell. So that gives you a really good idea of what next year's profits are. From that, you can estimate your earnings per share, just dividing by the amount of outstanding shares. And then you can forecast the stock price. Because if earnings, stock prices, like we talked about last class, have PE multiples. And that's the factor of how big the stock is in relationship to earnings. So if a company has a PE of 20 and it puts on a new dollar earnings next year, the stock price is going to go up $20. So we have all these relationships that we know of in the stock market and how companies have these percentages and these relationships we developed through the ratios we talked about in the last chapter. And also connected to your finance class that you really should have took before this class, which has pro forma financial statements that estimate how you're going to do. And just like in a simulation, when you put in all your information for the year, at the end they generate a pro forma financial statement that gives you estimated amount of profits. And a lot of times, I can't tell you how many times students came back to me and said, well, the simulation said I was going to make 43 million, but I actually lost 5 million. That's wrong. I said, no, that was an estimate, and you badly forecasted. You made bad management decisions. So even though if everything you wished for came true, you would have had that 43 million. But you didn't do that. You did things like you said you were going to sell 40,000 cars where your demand was only for 5,000, and that's why nothing did materialize, because your hopes and wishes don't always equal profits. So that's one thing that can go wrong with some of this valuing a company. Somehow, unexpectedly, companies' expenses went up, or their advertising became more aggressive, and it eats more into their sales, their profits from their sales. So everything isn't always the same. It isn't always the same percentages, but we're trying to hope that it will be close. Okay, so forecasting future sales is based upon historical trends. And historical trends adjusted for anticipations and changes in operations or environment. And again, this was talked about more in the finance class, but basically, say you work at a movie theater that has one screen. And you know that in the summer, you always get a big blockbuster movie. That should lead you to think, oh, you know what? I'm going to have more demand. I should order more supplies and maybe hire more employees. Or maybe you're Party City. It's around Halloween. Do you know the store called Party City? Does anybody here like to party at Party City? I think that's their advertisement. Anyway, why is Party City doubling their inventory and hiring right now? Yes, I just gave the answer in the previous sentence. It's Halloween. This is where they do 40% of their business, selling Halloween costumes. Just like a store that's a Christmas store, and some Halloween stores just pop up just for the month before, just for like 6 weeks before Halloween. They just come up out of nowhere, and suddenly there's this Halloween store that's just nothing but Halloween. So they know that I need to get the inventory and the employees because this is where the demand is going to be. And if you mess up and you don't buy all this stuff and people come in looking to buy it, they're going to another store. So it's just common sense, common business sense to help forecast sales and demand. And the more experience you have in the industry, the easier it is for you to forecast the sales of the industry. And so you as an analyst, usually analysts specifically focus on one industry for all their analysis, because the more you can get familiar with those companies in the industry, the more successful you'll be at guessing where the future values will be. Okay. Forecasting net profit margins is really based upon historical trends of the relationship between sales and profits. So if they follow historical trends, it should be relatively easy to forecast the profits. And the earnings forecasts are really what we're trying to do, because that's what moves stock prices, the increase in earnings. All right. So here is a formula. If you get the estimated sales for the year and you multiply it by the estimated profit margin for the company, then you will have your future after-tax earnings for the year. So really, that's why we calculate the net profit margin, because that's a percentage. We just multiply idiots, to get our result, which you can just see here at the bottom of the screen. So again, it's a really simple formula. Now, the estimated earnings per share, again, is going to take the future after-tax earnings, that's basically net profits, divided by the number of outstanding shares, and that's what gets us our estimated earnings per share. And that's really important. To have the forecasted earnings per share, that's where all your stock predicting capabilities come in. Because if you could tell me specifically what the earnings per share would be for any company next quarter, I can make money from that. Apple just released earnings the other day. I'm not sure how they're doing. I'm not even sure how the market's doing today. I didn't check. But, if I know certain pieces of information, if Apple's share earnings are going to double, then I would put every cent of money I have in buying that stock today. If I know, actually more specifically, one thing that could put a wrinkle in this is if I'm the only person that knows that for sure. If everybody knows that, then the stock price will go up to that level immediately. So the little wrinkle is I need that information to be just something I developed for myself. Maybe I have a crystal ball and I soar into the future. Or maybe I took a DeLorean and I put in a pulsating fuse capacitor inside of it, and I raced it at 80 miles per hour towards the clock and went back, a couple days in time. What movie am I talking about? Now I'm asking her. You've ruined it. Okay. Do you know that movie? Back to the Future? Okay. Do you have Netflix? Oh. Never mind. Okay, so step 2, forecast the future earnings per share. Here we're going to look at, we have our estimated profits and we have our outstanding shares, so this is what actually gets us that earnings per share. Now, the earnings per share estimate is, if you develop this yourself and you feel it's more accurate and that most people don't know this, then that's something you could buy the stock on. But if it's something that the company comes out and say, yeah, this is what we expect our earnings to be, as soon as they tell everybody what they expect their earnings to be, the stock price goes up. So it doesn't happen at the announcement. The only thing will change at the announcement if they say we expect $3.25, the day that they could have estimated 2 months before, the quarter before, the stock price will rise on that. But then if earnings actually come out and it's actually $4, not 3.25, then you get that surprise bump up in the stock price. And that's what we're all looking for. We're all trying to figure out a stock whose earnings are actually going to exceed their estimates because of maybe some changes in the economy or in demand or certain things that they didn't know about. Like that company that makes the hazmat suits, they didn't know that Ebola was going to come to America so soon, and their sales really increased greatly, something they weren't able to forecast 3 months ago. And that's why people are anticipating higher earnings. They're anticipating higher earnings for the stock, so they're pumping the stock up now. But people have already gone and done that math. The people who did that earlier made more money than people who did that later and bought into it later. Okay, so here's the formula for forecasting dividends. Dividends isn't important as much because we don't really concern ourselves too much with dividends. But if a company, if we want to calculate the estimated dividends, if we had the estimated earnings per share times the payout ratio, some companies give us the payout ratio, we could actually calculate the dividends. This is only important for stocks where dividends is the main focus of the stock, where paying dividends is the reason people buy the company. It's not an exciting company for other reasons. Maybe it's a utility, so it's not going to grow, but we always are. It's not going to grow a lot in capital gains, but the dividends typically grow, and that's what we depend on. Then the actual value of the stock is more tied to the dividends than the actual, than anything else. And in those cases, knowing the estimated dividends is an important thing. So forecasting the future dividends, of course, if we have the earnings per share multiplied by the payout rate, then we'd be able to calculate next year's dividends. And for some of the models that we're going to be looking at, some of the valuation models we're going to be looking at in this chapter, valuing future dividends is key to figuring out what the future stock price is. And this was more important 100 years ago when dividends were a main focus of stocks. Today, dividends aren't as big of a focus for most stocks, so a lot of these valuation formulas would not help you give you the price information for what would be a good time to buy or sell the stock. Okay, so the estimated PE ratio. Now, stocks have generally their own PE that they maintain, but sometimes the market itself could go in these bubble or contraction phases that will change the overall PE of the market in total. So we want the average market multiple for all stocks, and that changes. Sometimes it's 15, sometimes it's 20. It's just every stock out there averaging all their PEs together. And we want to compare this to the relative PE of an individual stock. And we might make adjustments up or down based on expectations of economic, content, the general stock market outlook, and people's how optimistic or pessimistic they feel about stocks. But we want to develop, a forecasting PE model or ratio. So if we want to estimate the PE ratio, there are a lot of factors. You have to understand. Do you ever post something on Facebook and you got 3 likes, right? Ever post a YouTube video and get a few likes on it? Because I don't know what that feels like because none of you guys ever like my videos. Is it really so hard just to click that little like button for me? Maybe at least leave a nice comment? I mean, I don't have to record these. I'm doing this extra effort. Maybe you could just do 1 click for me because that makes me feel so great about myself. But I do. That's an exaggerated example, but the likes you get on a video tell you how much people think it's good, and that gives you a hint as a viewer. Like, yeah, I want to look at this. Like, if 5 million people said this is great, I want to see what this is about. It's the same thing with stocks. The PE ratio is like a measure of the likes. So if people like a stock and they keep buying it and they tell all their friends about it and they buy it, the PE multiple is going to increase. So it's sort of a likability factor. The higher the PE multiple in the stock, the more people like it. And things that make people like a stock is growth rate and earnings, if that increases. General state of the market. If you're just hyped about stocks, the stocks are going up, you're going to like stocks a lot better. The amount of debt the company has. The less debt, the more you like the stock. The current and projected rate of inflation, that's again level to your mood, and the level of dividends. So PE multiples will, as people realize the stock is more valuable, they'll like it more because it means they can make more money from it, and the PE multiple will rise. So we want to forecast the PE multiple to get an idea of how our earnings are going to relate to it. So if we could say the PE this year is 10, but we expect the PE to move to 12 next year and the earnings to move to 3 to 4, then that's how we're going to forecast. Here's the formula. How we're going to forecast our earnings. So the estimated earnings per share, estimated EPS for the year times the estimated PE ratio. Because we can't always go by last year's PE ratio on the stock. We may feel that, next year this stock's going to be more in demand. People are going to know more about it as the earnings and sales are growing. I expect the PE multiple to go up as well as the earnings. So every time we increase the PE multiple, we're going to have a higher stock price. So if earnings increase, we have a higher stock price. If PE multiple increases, we're going to have a higher stock price. All right. And then that I had that trend analysis chart that could kind of be the starting point. You know, the McDonald's where I had 2003, 2004, 2005, 2006, and we're putting growth rates in there. You know, a lot of companies, as far as forecasting summary statistics, they will start with a couple of actual years and help build a model to extend it forward. If they're assuming that, you know, the annual growth rates in sales are going to be something similar to what they've had in the past, and they're going to have, you know, a certain amount of growth and profit margin they can expect, we can use all these expectations that we build based on facts about the company, what they've done in the past, what they're likely to do in the future, how well we know the company, and then we could build our future estimates, forecasted estimates of the company's stock price. So we could say that, you know, it helps when the company is really, really reliable, and every year they increase sales by 5%. Every year their profit margins go up by 0.5%. The only problem is the more reliable that data is, the more easier it is for everybody to forecast it and build the price of that into the stock right now. So sometimes the way to make money in the stock market is to be a little bit more of a creative thinker, or see a trend, or see a divergence in the company's financials that most people aren't aware of or can't perceive, and then build your forecast on that. And if you're right about this change, you know, maybe the change could be people are in society are suddenly going to move away from actually wearing sneakers into all shoes. And maybe they'll make shoes you could work out in, and people want to look stylish when they work out. Let me tell you, they have already switched to dress socks at workout time, so you can wear black socks when you work out. If you go to the gym, I was shocked as shit to find this in the gym. I'm like, holy cow, I can wear my black socks here? I never have to put white socks on again. I could come right from work and work out my dress pants as long as I have my black socks on, because it's cool now. I don't know how that happened. It just happened in the last year or so. Right? Anybody corroborate this with me? Have you noticed this? You don't even go to the gym, so shut up. I'm just kidding. I never see you at the gym. I think we go to 2 different gyms. That's probably why. All right. But notice next time, you'll see most of the people who are with it, meaning they're under 25, are wearing dark socks. What? You're wearing black socks. Okay, so you agree with me. It used to be a few years ago, it was those socks that don't look like you're wearing socks, where they kind of hide in your shoe. So it was a no sock. And when I was in high school, it was the socks that went up to here that had 3 stripes on them, colors. And with the tighty whities. Things change, that's the point. The whole point of this is, one, to make the lecture a little bit more interesting, so you don't have to stare at your laptop as much, and 2, to kind of show you that things change dramatically. So maybe I could turn that into, if there was 2 companies, one that sold white socks and one that sold dress socks, I would sell the company that sells white socks and start buying the company that sells dress socks, because now you can wear them all the time, because they have sport-related dress dark socks now. I don't know. Okay, so using the stock valuation, this is just common sense. If it's the estimated price is greater than the current price, it's undervalued. If the estimated price equals the current price, it's fairly valued. And if the current price is greater than your estimated price, it's overvalued. That's just common sense. Okay, so let's talk about the valuation process. Risk and return play in quite closely to determining the worth of a security. So the valuation models have been created to help us mathematically get an idea of what a stock is worth. So if we're looking at things like the expected rate of return is equal or exceeds our target yield, the stock would be a worthwhile investing candidate. So these are just some principles. If the intrinsic value is equal or exceeds the current market value, the stock will be a worthwhile investment. So these are just basic concepts that we already know. We're trying to find stocks that are very valuable today that people haven't realized that yet, and the stock prices haven't gone up yet. So whatever the stock price is today is the general consensus of what they think the future price should be in 2 or 3 months from now. If you have a reason to doubt the general consensus, if your analysis is just a little bit better, a little bit more accurate, then you can make money with these valuation processes. Again, returning to the capital asset pricing model, this is something that we talked about in the beginning of class when I was showing you those test questions. This is the capital asset pricing model that we also talked about in chapter probably 5. And here again, we need a required rate of return to measure so we can compare the actual return of the company compared to what's required for the risk. And in this, we'll use this capital asset pricing model to use the factors of risk-free rate, which is the treasury bills, the stock's beta, and multiplying that by elevating the market return, taking away the risk-free rate, using the beta to magnify or contract that, adding the risk-free rate back into that result to get a required rate of return. And this is just basically a formula using beta is the measure of risk. The market return is what we expect from general market. Because they're correlated to each other. So if the beta is higher, we require a higher rate of return than the market. So we always want to magnify the market part, but not the risk-free part. That's why we subtract it, because we don't want to magnify that. And this gives us a good look. So if our estimates show a 10% return, but we actually require a 15% return, then the risk and the reward doesn't match up and we shouldn't buy. And that's basically why we look at required rate of return. Here's an example that, just a calculation example. We'll do that in one of the handouts coming up, I'm sure. This gives us the inputs, and it's testing whether or not you know the order of operations, or if you know how to properly string together a formula in Excel. Because the math here is not difficult. All right, so here are our evaluation models. These are historical models that probably the dividend valuation models probably won't work so well in today's environment, but the other price relative approaches will, as well as the price to earnings approach. So the dividend valuation models we're going to go over. The dividend to earnings approach we're not going to go over. And the other price relative approaches we're going to talk about as far as cash flow, price to sales, price to book value. These are alternative. And the way it works in the marketplace is once the valuations are established and well used, they're less useful because it tells everybody what the price should be, and they buy and sell the stock until it gets to that price. So your job as a good stock analyst is to develop a valuation model that's unique to you, that no one else is using. That gives you a little bit more accurate insight compared to the standard models that are out there. But most of those models you will develop will be based on these pre-existing models that we're going to learn today. So these are sort of like the building blocks for you to develop better models in the future. That's why we look at them. Because a lot of students will say, why are we learning these if these aren't necessarily going to make me any money? And the reason is you could utilize this information to build better models in the future, to build upon it. So they used to think the value of a stock was the dividends divided by the required rate of return would give you an accurate picture of the value of a stock. And this is the zero growth dividend model. It's pretty simple. You get the annual dividends. A lot of companies will state what they are, and you divide it by your required rate of return, which we saw from the previous slide. You could calculate it with the capital asset pricing model. All right. Now, I mean, the zero growth model denotes that there is zero growth in the dividends. So it's not really that well used the model because very few stocks say we have zero growth. Now, a constant growth model is a company that would say every year we're going to grow our dividends by 5%. So we would take, if we want to know what the value of the stock should be, we can take next year's dividends, divide it by the required rate of return minus the constant rate of growth in the dividends. And this again will give us a stock price. So we're trying to figure out, knowing next year's dividends, we'll calculate what next year's stock price should be. And if the stock price is below what we calculate next year's stock price should be, we buy it. So this is just another one of those dividend models. But the key thing here is assuming a constant rate growth, and very few companies will say we're going to constantly grow our dividends at this percentage. It just doesn't happen. The variable growth is a little bit more realistic, where dividends grow in a variable state related to the amount of profits a company makes. The more profits they make, generally the more dividends they pay. Now, here we're going to look at the present value of we're actually taking present value into account here. So we're going to take the present value of the future dividends during the growth period, and we're going to add that to the present value of the stock price at the end of the variable growth period to give us the value of the share. So it's basically saying, let's take the present value of the stock price, and we're going to add that to the additional value of the future dividends. And that should be what the stock price should be. Because we're saying that the stock price, part of the stock price's value is the money it pays you. So if a stock is going to pay you $10 a year in dividends, wouldn't you expect that stock to be more than $10? Because basically, if it was $10, everyone would buy it. Because I buy the stock and in 1 year it pays me back. So I basically own it for free. And then every year it generates money. It's just, that would be such an unbelievably undervalued stock. Typically, if a stock's going to pay $10 worth of dividends, we're talking about a $200 stock. All right. But we want to see what we're trying to measure the amount of value the dividends play in the growth of the stock price. So here, in a variable growth method, we could outlay a sequence of dividends that are going to be variable. They're not going to be the same amount. And then we could calculate what the value of the stock price would be. And again, we're just introducing these concepts and formulas. We'll practice these more next time in class. The dividends and earnings approach is a hybrid of using the dividends plus the earnings. So we want to look at the present value of the future dividends and add that to the present value of the stock at the date of sale to get the present value of a share of stock. So this is just another valuation model that's trying to assume I guess like a capitalization value between the annual dividends and the future sales. This model I don't really believe in too much. I don't feel it works or is beneficial in today's world too much. This is you could review the model and see how you feel about it. The model pretty much that is very successful even to today is the price to earnings model, where we're looking at the earnings per share times the PE ratio. And here again, if we had future earnings per share and future PE, we can predict a future stock price. And since it's been proven quite conclusively that earnings per share and PE ratios have a huge influence of future stock prices, you could see why it's the most widely used stock valuation approach, and it works. It just is a really good approach because everybody's focused on earnings per share and PE multiples. And if you have a good estimate of where PE multiples are going, even if you're conservative and say, I'm going to keep the PE multiple constant and you just work off the growth in earnings, you still get a pretty good accurate stock price. Okay. Now for a company that may be a little challenged on profits, you may look at cash flow instead of necessarily profits. Because it can be more accurate than profits. Because cash flow is not as manipulated as profits. Because profits are manipulated to be smaller to reduce taxes. But cash flow is cash flow. So it's a more pure sense of what the company generates in its business. So here we would look at the stock price, the price of common stock divided by the cash flow per share to get what we call a price to cash flow ratio. And we want the smaller this ratio, the more cash flow is represented in the stock price. So we would want, we would want companies to give us an opportunity that we realize that the cash flow, we have a generous amount of cash flow per share, and it's not yet priced into the stock price. So if we had a ratio of 1, I mean the stock price is $100 per share and the cash flow is $100 per share. We would consider that undervalued. So we would want to see what the industry average is for the industry. Maybe the industry average is 5. So that means the stock should really be at stock price should really be at 5 times the cash flow per share, if the cash flow was if this ratio was 5. Now the price to sales approach. Think of a company that is a new company starting out where they're rapidly growing their sales. Maybe like. But I can't give a good example. But there's maybe like Amazon or in the beginning where they're rapidly growing their sales but no profits. So you could use this approach where you're looking at the stock price compared to the sales per share. So profits and cash flows aren't so clear because it's a fast-growing company where they're putting, and Netflix was this way for a while, they're putting all their money into expanding operations and seizing the opportunities before somebody else can. Like when Netflix was competing with Blockbuster online for a short while. So they weren't concerned about showing profits. They were concerned about increasing their sales. So if you make this relationship between stock price and sales, and you can show that every time sales doubles, stock price doubles, doesn't matter if they've never made any profits, you develop that relationship, then that can give you an insight to where the stock price should be. So think about companies like Twitter and Facebook and LinkedIn that for a long while didn't have any profits, but were rapidly escalating in sales. Or, in sales. So that would show that at some point they're going to have enough sales to cover their fixed assets and their expenses, and they'll generate a profit. But as long as they have that extreme growth in sales, there's this big opportunity somewhere down the line. But we can't really use earnings per share yet because, we don't know. We could also look at book value compared to stock price. And it's just substituting book value. And again, could show us, if we have an industry average of what the price to book value ratio should be for the industry, and we have companies that deviate from the average, it will show either overvalued or undervalued. And typically, if the stock price, if this number gets smaller, then the company's undervalued because the book value is getting closer to the stock price. Okay, so this was sort of a short chapter. A lot of the work will be done next class when we're actually going to work on the handouts. So next class, there will be no PowerPoint presentation, but there will be a lot of hints on the test, plus a worksheet to reinforce a lot of these valuation models. So please read over Chapter 8 before Monday.